Achieving financial freedom and building long-term wealth are aspirations that many people share. Unfortunately, the idea of investing in the stock market can be daunting, particularly for those who are new to investing. It can be challenging to know where to start, what stocks or funds to buy, and how to manage your portfolio. However, the good news is that investing in the stock market has never been easier or more accessible than it is today, thanks to advancements in technology and the availability of low-cost investment options. If this sounds like you, stay with us. There is a common misconception that investing in the stock market is reserved for the wealthy or those with extensive financial knowledge. However, this couldn't be further from the truth. In reality, anyone can start investing in the stock market with just a small amount of money and a basic understanding of how it works. The finance industry often tries to create an illusion of complexity to make themselves appear more knowledgeable and indispensable. However, in reality, simplicity is often the key to success in finance, as in many other aspects of life. Retail investors may be discouraged from participating in the market because they believe they lack the necessary expertise to understand it. But keeping things easy can be a powerful strategy for building wealth. One of the most straightforward and reliable investment strategies is investing in index funds. These funds offer broad exposure to the market and have proven to be a safe and effective way to build wealth over the long term, whether you're just starting your investing journey or looking to refine your existing strategy. In this video, we'll explore why index funds are an excellent choice for investors, how they work, and the advantages they offer over other investment options such as individual stock picking, mutual funds, and actively managed funds. We'll take a closer look at the benefits of investing in index funds, including their low fees, broad diversification, and historically strong long-term returns. When you invest in an index fund, you're essentially buying a small piece of every company that is included in the index that the fund tracks. For example, if you invest in an S&P 500 index fund, you'll be investing in the 500 largest publicly traded companies in the United States, including tech giants like Apple, Microsoft, Google, and Tesla, as well as other companies like Walmart and Johnson & Johnson. Similarly, if you invest in a technology index fund, you'll be investing in a portfolio of companies that are primarily focused on technology, such as Amazon, Meta, and Nvidia. The beauty of index funds is that they offer diversification across a broad range of companies and industries, which helps to reduce the risk of individual company performance affecting the overall performance of your portfolio. By investing in an index fund, you're not required to research and pick individual stocks, which can be time-consuming and challenging for those without the expertise. Instead, the fund is managed by a professional who is responsible for selecting and managing the portfolio of companies included in the index. The beauty of index funds is that they offer broad exposure to the market and are relatively low cost. Unlike actively managed funds, which try to beat the market by picking individual stocks, index funds simply aim to match the performance of the market they track. This means that you don't need to worry about trying to pick winning stocks or timing the market. By investing in an index fund, you're essentially investing in the entire market, which has historically provided solid returns over the long term. One of the key advantages of index funds is the power of compounding. When you invest in an index fund, you're not only earning returns on your initial investment, but you're also reinvesting those returns. Over time, this compounding effect can lead to significant growth in your portfolio. Let's say you invest $10,000 in an index fund that tracks the S&P 500, and you hold on to that investment for 30 years. Historically, the S&P 500 has returned an average of around 10% per year. Assuming this rate of return continues, your initial $10,000 investment could potentially grow to over $174,000 after 30 years. This is the power of compounding. But compounding isn't just about reinvesting your returns. It's also about the length of time you stay invested. The longer you stay invested, the more time your money has to grow. This is why it's important to focus on the long term when investing in index funds. The longer you stay invested, the more time your money has to grow. This is why it's important to focus on the long term when investing in index funds. Another advantage of index funds is that they're a much safer way to invest compared to short-term trading or trying to pick individual stocks. When you invest in an index fund, you're spreading your money across many different companies and industries, which helps to diversify your portfolio and reduce your risk. By contrast, if you were to invest in a single stock, you'd be putting all of your eggs in one basket and exposing yourself to much higher risk. Furthermore, index funds are typically passively managed, which means that they don't rely on a fund manager to make investment decisions. This reduces the risk of human error or mismanagement, which can occur with actively managed funds. Investing in index funds is a simple and easy way to start building wealth and achieving financial freedom. By focusing on the long term, taking advantage of the power of compounding, and diversifying your portfolio, you can potentially earn solid returns over time. However, it's important to remember that investing always carries some degree of risk, and you should never invest money that you can't afford to lose. If you're new to investing, it's always a good idea to speak with a financial advisor who can help you determine the right investment strategy for your goals and risk tolerance. They can also help you navigate the different types of index funds available and find one that's right.